A very good evening to all the participants of this webinar from DTRTI Lucknow as part of the DTRTI Lucknow webinar series for 2021. And today in this webinar, 6th of November 2020, we are going to study Bank Reconciliation Statement Part 4 as part of the Bookkeeping and Accountancy series of webinars being conducted by DTRTI Lucknow. So friends, we have already covered a lot of ground as far as bank reconciliation statement is concerned, and we move forward from where we were. So bank reconciliation statement after preparation of the adjusted cash book, that is also a method of preparing a bank reconciliation statement after preparing this adjusted cash book. So what is the meaning of this adjusted cash book? Now what happens is that when the balance in the cash book is initially adjusted for certain adjustments before taking the cash book to the bank reconciliation statement. Before preparing the bank reconciliation statement, certain adjustments are made to the cash book. Then whatever balance we get after making those adjustments, that is known as the adjusted cash book balance. Now, adjusting the cash book before preparing the BRS, the bank reconciliation statement, it's a completely optional thing. You may want to do it, or you may not want to do it. In case the reconciliation is done in different months. However, what if you are doing the reconciliation at the end of the accounting year or at the end of the financial year? Then the cash book must necessarily be adjusted so as to reflect the correct bank balance in the balance sheet. So now, what are those adjustments that are to be made at the end of the accounting year? In between the year, if you are preparing the bank reconciliation statement, you may or may not do the adjustment. It is your choice, it's your option. But if you are doing it at the end of the accounting year, then you have no option and is mandatorily required to be done. Now, while adjusting the cash book, what are those adjustments that need to be done? So number one, all the errors need to be corrected. If the cash book is not written correctly, if there is an error made in the cash book, for example, wrong amount is written in the cash book, or an entry is posted 2 times in the cash book, or if the total is not correctly taken, or we can also say entries made on the wrong side of the cash book. So whatever errors can be made in the cash book, whatever there are the errors, whichever errors are there in the cash book, they need to be corrected. We had already discussed earlier that whenever there are differences between the bank balance of the cash book and the bank passbook, there could be due to 2 different types of reasons. The first reason is the reason because the entries has been made at different times in both the books. And therefore, if the entry has been made at different times in both the books, then it is possible that if between those times we are making the bank reconciliation statement, we may not find the same entry in both the books. And that may lead to a difference. But on the other hand, the difference could also be due to an error in writing the book. The error in writing the cash book or error in writing the bank passbook on part of the bank. So whenever errors are made in the cash book, at the end of the year, if we are making a bank reconciliation statement, we need to make the corrections because we can't have error prone or error full cash book with us. Number 2, omissions like the bank charges recorded in the passbook only, or interest which is debited by the bank but not credited in the cash book. Similarly, direct receipt or payment of a check in the bank, or a dishonor of the checks or bills. These are the omissions in the cash book. Because why these are the omissions in the cash book? Because there are certain entries in the bank passbook and those entries have not been made in the cash book. So before starting to prepare the bank reconciliation statement, it's better that we identify those entries which are there in the bank passbook, which have been made by the bank and not noticed by the cash book accountant. So definitely it is something that the cash book accountant has missed out or has omitted by mistake. He's not duly diligent about his work, and therefore he has made an omission. So if the accountant makes an omission, he needs to correct his omission. So basically, omission is also a mistake. It is a type of error. He should have done it. Why not? If the bank is making an entry, all he has to do is open the internet banking account and copy the entry from there. What's wrong with that? Why is he not doing it? So therefore, two types of adjustments have to be made. One is the errors in the cash book, which are due to the reason that cash book is not written correctly, and number 2 is the omissions made in the cash book relating to entries in the bank account, in the bank passbook, but not there, which are not there in the cash book bank balance, cash book bank column. Now, these transactions have to be considered for adjusting the cash book. And apart from this, delay in recording the passbook due to the difference in timing, like check issued but not presented for payment, check deposited but not collected, these items are taken to the bank reconciliation statement. So apart from the items which are corrected, the other items have to be taken to the bank reconciliation statement, and the adjusted cash book balance is therefore taken to the bank reconciliation statement. You have to remember that if there are any errors occurring in the bank passbook, we don't have to adjust them in the cash book. No. You have to remember that very correctly. All the adjustments considered in the adjusted cash book are not carried again to the bank reconciliation statement. This also should be remembered. Something which has been already corrected cannot be corrected twice. So, and something which has been corrected need not be reconciled. So, need not be taken to the bank reconciliation statement. Now, let us see an illustration in this respect. On 30th of September 2017, the bank account of X, as per the bank column of the cash book, it was overdrawn to the extent of 4,062. Now, overdrawn means there was a minus balance of 4,062 as per the bank column of the cash book. On the same date, the bank statement is showing a debit balance of rupees 20,758. So there is a difference between the bank statement and the cash book bank column. Now, an examination of the cash book and the bank statement revealed the certain errors. So the errors are mentioned here. Now, what is to be done is that we are required to show what rectifications or what corrections or what adjustments are required in the cash book of X to arrive at their correct balance on 30th of September 2017. And we are also required to prepare a bank reconciliation statement. So first thing first, what we are going to do is that we will make the entries over here for correction in the cash book. So we take up the cash book bank column and we try to make the corrections, and then thereafter we arrive at the adjusted balance, which is, you can see, 11,242. And once we arrive at the adjusted balance, thereafter we start with the adjusted balance, and then move towards the overdraft, or move towards the balance as per the bank statement, as part of the bank reconciliation statement. So now let us see what are the things that we are doing in the cash book, the corrections that we are making, the errors that have been made. So the errors have to be corrected. Whatever errors have been made, those errors have to be corrected. Now these errors are part of these reasons for the differences, or the causes of the differences here. So first thing what we have to do is that we have to decide that any item here, is it an error or is it an omission? If it is an error or omission, then we need to correct it. We need to adjust the cash book for it. If it is not an error or omission, it will go to the bank reconciliation statement. So we will proceed one by one. So let us take the first example, or first entry here. There is a check of 13,14,000 rupees which was deposited on 29th of September 2017. Mind you, we are making the bank reconciliation statement for 30th September. As you can see here, we arrive at the correct balance on 30th September, and then we make a bank reconciliation statement. And here it is mentioned that a check was deposited on 29th September, but it was credited by the bank only on 3rd of October. As we can see here, it is in the normal course of the business. A check is deposited and it will be credited later on. So nothing wrong with it. No error, no omission. Second entry. A payment by check for 16,000 has been entered twice in the cash book. A payment has been made by check only once, but it has been entered two times in the cash book. Obviously, there is an error here. So payment has been made, so payment needs to be reversed one time. So to reverse the payment, we will debit the cash book with 16,000 rupees and credit the party account to reverse the payment, which has been shown two times earlier. So we start with a balance here in the cash book, and then we debit the cash book here. We are starting with a credit side balance in the cash book. Means it is a minus balance, 4,062. And then we are crediting the account here. For the first entry, 13,14,000 rupees. If we are answering this question in an examination or anywhere, all we have to do is, if we have decided that we'll go to the bank reconciliation statement, we write this line over here, overdraft as per cash book, leave it empty initially. Then this check of 13,14,000. We have to decide whether it has to be added or subtracted, but that will depend whether the opening balance is an overdraft or not. So we'll just wait. We have no other choice but to wait and prepare the cash book balance first. Then we go to the third entry. On 29th September, the bank credited an amount of rupees 1,17,400, which was received from a customer of X, but the advice was not received by X until 1st October 2017. What happens is that the advice was sent to X that somebody has credited an amount of rupees 1,17,400. X did not receive that advice till 1st October. So as on 30th of September, he does not have this information about 1,17,400 being credited by his customer in his account on 29th September. because he received this advice later on. So it's fine. If he did not receive his advice, it is not his mistake, as per the question, because he will act on the advice. If he did not receive any advice, not his mistake. So therefore, we can take it that since it is not his mistake, but at the same time, we have said in the rules that as far as any amount which is credited or debited in the bank account is concerned, we treat that as an omission, and therefore we adjust the cash book for that amount. So therefore, we will adjust this 1,17,400 also. So bank has credited this amount, but it is not in the cash book. So we will debit the cash book with this amount to increase the balance of the cash book and credit the customer account by 1,17,400. So this adjustment is made as part of the omission. Now, bank charges amounting to 580 have not been entered in the cash book. Once again, bank charges have to be entered in the cash book. So now we'll adjust the cash book for the bank charges, and we are crediting the cash book here because money is going out of the bank to out of the bank account to the bank. So therefore, the bank balance will be credited for 580 rupees. In the bank passbook, this entry is already there, but as part of the omission here, we are making the entry out here also. Now, on 6th of September 2017, the bank has credited 20,000 rupees to X in error. Now, this is a case where bank has made a mistake, and by mistake, the bank has credited 20,000 to X. Now, if bank has by mistake credited this 20,000, bank will reverse this entry later on. It is a mistake of the bank being made in the bank statement. So the rule is that if any error is made by the bank, the cash book is not supposed to be adjusted for that error. So therefore, this 20,000 will go straight to the bank reconciliation statement, as you can see here. Then the bill of exchange for rupees 1,40,000 was discounted by X with his bank, which means that X received this money from the bank by discounting a bill of exchange, but this bill was dishonored on 28th September. The bill was dishonored on 28th September. So the bank knows that the bill has been dishonored, but in the books of X there is no entry of this dishonor, but bank has made the entry of this dishonor in the bank account, and therefore it is a case of an omission because something is there in the bank account which is not there in the cash book, and therefore we need to adjust this amount of 1,40,000 in the cash book here. We are crediting the cash book for dishonor of the bill and debiting the customer account because this is a bill which was received by us from a customer under the promise that customer will pay on a certain day. So we went forward and we discounted the bill with the bank, and bank gave us that payment against the bill earlier, and now when the time came for the payment, our customer refused to pay the money to the bank, and therefore the bank who had given us this money under the respecting the promise of the customer, of our customer, they will be reversing this entry here, and therefore the bank has debited us, and therefore it has taken out this 1,40,000 amount from our bank account, and therefore we'll be crediting the bank column here by 1,40,000 and debiting the customer, because now we have to receive this amount from the customer. The bill which he had given, it has it is now already dishonored, stands dishonored. So we have to receive payment from him, which he had given to us in form of the bill earlier. So now the next entry is checks issued up to 30th September but not presented for payment. Up to that date totaled 13,26,000. What is happening here is that checks were issued, but the parties to whom checks were issued, they did not present them to the bank. So no problem with our books of accounts. We have done our job. We have issued the checks. They did not deposit it, so the money could not be cleared at all. So the money could not be cleared in the bank. Even the bank doesn't know anything about this, and we have just issued the check. So we have already entered these checks in our cash book, bank balance or bank column, but there is no entry, no corresponding entry of these checks in our bank account. So this is neither a case of omission, nor is it a case of error. So it will go straight to the bank reconciliation statement. Okay, having done all these things, now after having adjusted the cash book, we are getting a balance of 11,242, a debit balance of a credit balance rather of 11,242, and therefore we carry it forward and we say we have an overdraft balance of 11,242 as per the cash book. Now this is a minus balance. So knowing that this is overdraft balance, now we find that we have some checks which were deposited by us in the bank, so they are entered in the cash book. These are the receipts. They had raised our cash book. They had raised our cash book amount, but we have not. But there is no corresponding entry since they are not collected to 30th of September. There is no corresponding entry in the bank statement, and therefore, since we are moving from the cash book to the bank statement, we'll have to minus this amount from the cash book. We'll have to reduce this amount. So we are making a minus here. Reducing from the cash book means that we are reducing the balance of the cash book. The balance of the cash book is minus 11,242. To further reduce it by 13,14,000, we'll do a minus 13,14,000. So in essence, what we are doing is that we are adding the two amounts. We are writing it as overdraft, but we are not writing any minus here. This is one kind of representation, the balance representation. So here we don't add plus or minus, so we just say that we are adding this. 11,000 plus 13 lakh, this is minus 13,25,242. And then there were some checks which were issued, but they were not presented for payment. Therefore, since the checkbook amount was lesser by these checks, we'll have to increase the amount to go towards the bank. And therefore, we are making a less entry here. So 13,25,000 minus, and we are reducing from this 13 lakh minus. If it was written as plus, then we have to write this as minus. If this is written as minus, then this has to be written as plus. 13,26,000 is being reduced here, and then there is also an entry of credit by the bank, erroneous credit by the bank. So if there is erroneous credit by the bank which is not there in the cash book, and we have to move towards the cash book, move towards the bank book. So obviously this is the entry by which we will be increasing the amount of the cash book, and therefore to reach the bank book. And in other words, we are actually lessening this amount over here. So minus 20,000 here. If the real amount was to be taken, we'll say it is minus 13,25,000. Then this is plus 13,26,000. This is also plus 20,000. Actually, it is going like this. But since we are writing this as a positive amount, and these items are being written as negative, and finally we get an overdraft amount of 20,758. Since it is coming in plus, we started with plus overdraft, and therefore we can say that as per the bank statement, we have an overdraft balance of 20,758. So by this, in this way, we have reached the overdraft balance which was given in the question itself, 20,758, and we have prepared the bank reconciliation statement thereby. Now we have to notice one thing here, that bank had credited X by 20,000 in error on 6th September 2017. Now if this mistake is rectified in the bank statement, then this will not be deducted here along with 13,26,000. If it is already rectified. If it is not rectified, then we are making the entry here so that we can reach the correct bank statement balance. Now let us look at another illustration called illustration 6. Now on 30th of December 2017, the bank column of A Philip is the name of the person. The bank column of A Philip's cash book, it showed a debit balance of 4,610. And when we examined the cash book and the bank statement, we found the causes of the differences. And we are supposed to make the adjustment in the cash book and of course prepare the bank reconciliation statement. So let us see how this is supposed to be done. We are trying to cover everything in detail so that it is easier to understand thereafter how the entries are made to prepare the bank reconciliation statement. We have to keep in mind that first we have to adjust the cash book for the errors and the omissions. First entry is checks which were amounting to 6,30,000 which were issued to the trade payables. Issued to the trade payables means somebody has sold something to us and we are supposed to pay him because we have traded goods with him, we have purchased goods from him, and therefore we are supposed to make the payment. So for making the payment to the trade payable, we are issuing a check of 6,30,000 rupees and we have entered that in the cash book before 30th of December. But these were not presented for payment until that date. We know that this kind of amount is neither an omission nor it is an error, and therefore it will go straight to the bank reconciliation statement. So while reading this, you can just keep on tick marking like the BRS like that. And therefore, you know that this will go to the bank reconciliation statement. If you are doing the exam on computer, in that case, perhaps if there is a space provided here to do rough work, then you can do the rough work here by writing BRS, something like that. If no space is provided online, then you have to do it on the rough paper. Now, number 2 is checks amounting to rupees 2,50,000 rupees recorded in the cash book as having been paid into the bank on 30th December, but they were entered in the bank statement on 1st January 2018. We have entered these checks in our cash book, but in the bank statement they are entered on 1st of January. So what is to be done? They are entered in the bank statement, something which is already found in the bank statement. They are something which is not found in the bank statement, and therefore it is not an omission in the cash book. It is not found in the bank statement, so obviously it will go straight into the bank reconciliation statement. Now, the next entry is a check for 73,000 and it had been dishonored prior to 30th December, but no record of the fact of the dishonor of the check appeared in the cash book. Now, this is a case where entry has come into the bank account because the check had been dishonored because we have deposited a check in the bank. However, when the bank sent it for clearing, the check got dishonored, but no record of this fact appeared in the cash book. It is there in the bank statement. So this is a case of an omission. So you have to enter here omission so that you know that you are going to adjust the cash book for this amount. Then you have a dividend of 3,80,000 which was paid direct to the bank, had not been recorded in the cash book. Once again, it is an omission which is mentioned in the bank statement but it is not recorded in the cash book. So therefore, adjustment of the cash book has to be made for this one also, just like for the 73,000 here. Bank interest and its charges amounting to 4,200 had been charged in the bank statement, but they are not entered in the cash book, so we'll have to adjust this amount in the cash book as an omission before we make the bank reconciliation statement. Then no entry had been made in the cash book for a trade subscription of 10,000 rupees paid via banker's order in November 2017. A banker's order was made, so the entry is there in the bank and no entry is made in the cash book. So therefore, again this is an omission and therefore this needs to be entered in the cash book by adjustment. Now a check of for 27,000 rupees was drawn by B. Philip had been charged to A. Philip's bank account by mistake. So maybe B. Philip and A. Philip are two brothers or something. This check was drawn by B. Philip, but it was actually entered in the A. Philip's bank account by mistake. Now, this situation is such that this is a mistake of the bank, and bank will correct this mistake. So, this does not require any adjustment in the cash book. Therefore, this amount will go straight into the bank reconciliation statement. So, we'll write a small BRS here. So, having analyzed all the causes of the differences, we go about preparing the adjusted cash book first of all. And as you can see here, we start with the balance brought down of 4610 and the dividend which was received in the bank account. For that, the adjustment is made here by debiting the cash book. And trade receivables were paid, but the check got dishonored, so dishonored amount is mentioned here. And bank interest and charges 4,200. Trade subscription which was paid but not entered in the cash book. So all these amounts are entered here, and finally we get the balance of 2,97,000 rupees. A debit balance of 2,97,000 rupees, which is carried here. This is the balance as per the cash book. We start with the debit balance, end with the debit balance, and this is an adjusted debit balance. So we start with the adjusted. You should write the word adjusted here, adjusted balance as per the cash book. And so this is adjusted balance as per the cash book. And then we, since this is a positive balance, there are certain checks which are not yet presented of 6,30,000 rupees, and we are moving from cash book to the bank statement. So therefore, these checks have been entered, but our customers have not presented them. So our cash book balance is lesser, our bank book balance is more. So we have to go towards more balance. So we add these checks over here, 6,30,000. We come to 9,27,410, and then thereafter we have deposited some checks. Lodgement means checks have been lodged into the bank, but they are not appearing in the bank statement. We have already entered in the cash book. So our cash book balance has gone up by 2,50,000 rupees. But we have to move towards the bank statement balance. So we have to reduce this 2,50,000 rupees here. And we get 6,77,410. Thereafter, checks which were wrongly charged to B. Phillips account. Actually, they were supposed to be charged to A. Phillips account. So that means that this check has been issued by A. Phillips. Therefore, but bank has entered them as having been issued by B. Philip. So bank has not entered them as having been issued by A. Philip. So therefore, what is happening here is that since we have already entered these checks in the cash book, and let us see whether these are the checks issued or checks deposited. A check for 27,000 drawn by B. Philip had been charged to A. Philip. It is the other way around. A check has been drawn by B. Philip, but it is charged to A. Philip. So wrongly charged to A. Philip by the bank. So since it is wrongly charged to by the bank to A. Philip account, which means that bank statement is showing a lesser figure by 27,000 rupees. So therefore, we are moving from cash to bank. So therefore, we'll reduce this figure over here to move towards the bank statement balance of 6,50,410. So this is how we, first of all, we adjust the cash book, and thereafter we make the bank reconciliation statement starting with the adjusted balance as per the cash book. Now we have another illustration here called illustration 7, and this illustration says that we are having to prepare a bank reconciliation statement on the basis of the data that has been provided here. So the data says that there is a bank overdraft as per cash book on 31st December 22,45,000, and there are certain other causes for the differences which are mentioned here, 7 causes, and then on that basis we are preparing the bank reconciliation statement here. Now, interest which is debited by the bank, normally what happens is that if we look at the entries here, interest debited by the bank on 26th December, but no advice is received so far. No advice is received so far. So what is happening here is that interest has been debited in the bank, although no advice has been received. But since it is there in the bank, so we have to make an entry in the cash book. So we'll adjust the cash book for this amount of 2,78,700. But in the question here, we are not asked to prepare the adjusted cash book. So there are two methods, as you can see, the adjusted cash book method or the other normal method. So therefore, what is happening here is that we don't need to prepare the adjusted cash book here because we are not asked to do that. In the question we are asked to prepare an adjusted cash book, then we should prepare the adjusted cash book, because although we are saying that at the end of the year, if it is done, then we have to do it. We have to prepare an adjusted cash book, but in the question it is not mentioned here that whether 31st December is the end of the year or not. we don't know whether they are following the financial year system or they are following the annual year system. So wherever there is a doubt and it is not clear that it is the end of the year. So over there, the choice is with us. We need not prepare the adjusted cash book. If we don't want to do that, we can straight away move to the bank reconciliation statement. Of course, the bank reconciliation statement in such a case would be a little longer, but still, if we need to do it that way, fine, no problem. So we have started with 22,45,900 here, and then we say that there's entry of interest which is charged by the bank. So interest is charged by the bank. Now what happens is that when bank charges certain interest, then the bank statement balance goes down, and if we look at the matter here, the advice has not been received. So therefore, this amount has to be adjusted because it is not there in the cash book, and bank has debited it. Bank has debited the bank statement by 2,78,700, which means that bank balance has been reduced already, but cash book balance has not been reduced. We are moving from the cash book towards the bank statement. Obviously, we are going to, because the bank balance is lesser, we have to go towards the lesser amount. But since we are starting with the overdraft, so we say even if we say lesser, if it is this minus, then we are doing a minus here. So basically we are adding. Then draft deposited in the bank but not yet credited. A draft has been deposited in the bank. So we have entered it in the cash book as receipt. So what is happening is that the cash book balance has been increased, but bank balance is lesser by this amount. So we are going towards the bank. So we are reducing the balance. Reducing means in this case we are adding 13,50,000. Thirdly, there is a wrong debit by the bank which is under verification. Bank has made a wrong debit which is still under verification. So therefore, it is not there in the cash book. Therefore, bank statement amount is lesser, cash book balance is more. We are moving from cash book to the bank, so we are reducing it. So in this case, we are going to add it because it's an overdraft. The checks issued but not yet presented, you can easily see that because we have done so many times. Transport subsidy not yet recorded in the cash book. A subsidy which is received in the bank account already, so which has increased the bank balance, but cash book balance is not increased. So we have to go towards the increased balance. So we have to go towards higher. So we have to basically add to the balance. But in this case, we started with overdraft, so we have to minus it. Bills for collection credited in the bank but not yet entered in the cash book. Some bills were sent, like the bills receivable, they were sent for collection. Bank has credited them. Bank statement amount has gone up. Cash book amount is lesser. So we basically add this, but since we started with overdraft, we are minusing it, and therefore finally we are getting an amount of 16 lakh overdraft, 93,600. So having done this particular illustration, which is starting with an overdraft. So as you can see, when we start with an overdraft, in such a situation, the entries get reversed. Wherever we are minusing, we are adding. Wherever we are adding, we are putting it in the subtraction. So with those words, having gone through a number of illustrations, I feel that there is a need to do another session along with illustrations and some questions so that we are able to finally seal this topic properly. So therefore, we will continue with this discussion, the practical discussion of how to go about preparing the bank reconciliation statement tomorrow morning. And therefore, we request you all to join us tomorrow morning. We come to an end of today's session.